Hi, Accounting 3. So we're ending chapter 20 today with looking at the work together for 20-3. And we are going to be using the current year, using page 2 of our general journal, page 3 of our cash receipts journal. And our first transaction that we're going to have here is that we've accepted a 90-day note, 8% note for Paul Gary for an extension of time on his account. So basically what we're doing here is he already has an accounts receivable, but now we're taking it out of accounts receivable and putting it into a notes receivable. So we're going to be looking here at February 2nd, putting it into that notes receivable. Source document is NR 17 for the amount of $1,800. And then we're going to take it out of his accounts receivable, Gary. And then that's that. So we just basically are moving it from one asset to a different asset. The difference being that before with his accounts receivable, he was not paying interest. Now moving it to a notes receivable, he is going to pay interest. On the 18th, we received cash for the maturity value of notes receivable 14, a 60-day 9% note for $500, receipt number 67. So we're going to go to our cash receipts journal. We're looking at February 18th. And we are going to be having our notes receivable. And we're going to be looking at interest income. Okay, so how do we actually calculate that? Well, if we take our 9% note, we have a 60-day, so 60 out of 360 times the 500. We multiply all that together, we're going to end up with $7.50. Okay, so that's our interest income that we actually earned on that. So interest income, we're going to be looking at $750. We're getting the note for $500, which means we are receiving a total of cash of $507.50. Okay, so notes receivables being canceled out, interest income is being received there, plus our cash is being received there, which I'm realizing I'm calling it cash debit. Anyways, the last transaction is Kirk Adams dishonored a note of 90-day 9% note. So what we're doing here is we are actually going to get rid of the note and put it back into the accounts receivable. So we're looking at the 27th. We're going to be putting it into his AR Kirk Adams. This is M25. And we have to calculate how much are we actually putting into his accounts receivable. And so that's this down here, 9%. It was a 90-day note at $400. This comes to $9. And that is what we're going to put in here to his account here. So the note was for $400. Now he has a balance of $409. The notes receivable was $400. And our interest income is $9. Okay, so that is us putting it back into our accounts receivable because he failed to pay off the note. All right. You are going to be completing 20-3 and 20-4. You're basically going to see on 20-4 that it is going to be worded differently. It's not going to be so straightforward, so you have to kind of make some assumptions. You know, instead of saying received, check, it's going to receive that a payment later on, that kind of thing. You're also going to complete your study guide, and then you can begin the mastery problem, but I'm not going to make that due until next week. All right, as usual, if you have any questions, please reach out. You can email me, you can pop in for office hours in the morning, or you can contact me and we can set up our own Zoom call. All right, see you later.